Good afternoon, everybody. My name is Terry Lake. I'm the CEO of BC Care Providers, Engage BC, and I'd like to welcome you to this afternoon's webinar, our Lunch and Learn on the Underused Housing Tax. But first, I want to acknowledge that we are on the traditional territories of the Musqueam, the Squamish, and the Tsleil-Waututh Nation. At least the offices of BC Care Providers are. I know people are joining us from around the province, and we know that all of us together appreciate the opportunity to work, live, and play on these traditional First Nations lands. Today, we're going to be talking about a significant issue that has come up inadvertently for many people, but still we'll learn about the importance of being knowledgeable about the underused housing tax. Of course, all of these taxes that we see are government policies aimed at trying to reduce the cost of housing as we see it out of reach of many. And as a father of millennial children, I can tell you it is very much out of reach for many people of that age. We have two presenters today. We have, first of all, Scott Gorski, a Senior Associate in Borden Ladner Gervais in their Tax and Private Client Group. Scott clerked at the Tax Court of Canada and has completed the in-depth tax program. Scott regularly advises private corporations on implementing tax-driven reorganizations and tax planning for trusts. Orla O'Malley is a Senior Associate in Borden Ladner Gervais LLP's Commercial Real Estate Group. She has a combined JD MBA from the University of Calgary. Her practice is focused mainly on transactions and real estate aspects pertaining to those transactions. She has experience advising long-term care owners and operators on acquisitions, dispositions, financing, and other general legal issues. Now, Orla has had some technical issues, so she may be connecting late, if at all. But Scott is going to start the program and run through with about 18 or 19 slides. That will take about 25 to 30 minutes, and there'll be plenty of time for question and answers. If you want to put those in the Q&A or chat module of the webinar portal, that would be great. And if there's any that we haven't got to, you can send us an email to Andrea, who will provide an email address, and we can follow up with you. So with that, I'd like to turn it over to Scott.
Thanks, Terry. As you mentioned, Orla should be hopefully joining us soon. She has IT currently helping her out. But in the meantime, I can certainly get going on this presentation for everybody. So the new underused housing tax. Didn't really, I'm going to be honest with you, expect that this would be so affected, that your industry would be so affected by this, but it is one of the things about this legislation that I think will be a theme is that, you know, what we have here is the federal government getting involved in a matter that's really, at the end of the day, more provincial jurisdiction. I mean, everything to do with real property is provincial jurisdiction almost. And it results in some kind of this overly broad, kind of ambiguous legislation that is also the government, the drafting of which is kind of trying to play catch up with the government policy and when the government wants it implemented. And it's posing challenges, as you'll see, for not just your industry, but many people. This first slide is just kind of to highlight all the various different taxes that there are and which one we're talking about, because I imagine many of you will be familiar that the city of Vancouver has its own empty homes tax, and that British Columbia has its own speculation tax. The city of Toronto has one as well. And these are distinct, annual taxes based on how property is used, as opposed to property transfer taxes or land transfer taxes like you get in BC and Ontario that target foreign owners. And then on top of that, you also have the newly enacted federal prohibition on the purchasing of residential property by certain foreign buyers. So today we're really just talking about the Canada one, the new underused housing tax. Now this came into force as of January 1st, 2022. Though the legislation wasn't passed by Parliament until, I want to say, June. It was about midway through 2022. we didn't get regulations to this legislation until December of 2022, and we didn't get any real government interpretation or guidance or anything like that starting to get released until January and February of this year. So while this tax is effective for 2022 and tax returns are due soon, we're only now starting to really grasp fully what, the full details of legislation, um, all the regulations and how that affected the legislation and the government's position on certain matters, which is why I say, in many respects, the government is trying to play catch up with its implementation date of January 1, 2022. The first filing deadline, so the tax returns, when they're due, are due April 30th of the following applicable calendar year. So for 2022, they're due April 30th, 2023, though, because that's a Sunday, that gets extended to May 1st. The government has also announced for this first year that it won't apply any penalties or interest on late returns or taxes paid as long as it's received by the CRA by October 31st. And I think that's kind of just a acknowledgement that this is a new tax, this is a transitional period here. And one of the distinctive things about, if you're at all familiar with the BC speculation tax or the Vancouver empty homes taxes, with those taxes, you're getting a notice telling you to file, right? You get a letter from the city or the government of BC saying, you need to file this return. Here's your unique declaration code. Go online and complete the return. And the reality is, in this case, with the underused housing tax, is that no one's receiving anything in the mail. So there's a lot of people that are going to be caught off guard and not really aware of this, because as far as I'm aware, I mean, there's not really all that much being done by the government to send notices out. And if anything, you've probably only seen, email blasts going out from large accounting firms, and hopefully you're on one of their mailing lists and they were alerted you to this. That's probably how most people are going to find out about this. I have a link here. There is some good information there from CRA. So in that link, you can find links to the form, the tax return form. You can find links to the government's policies and guidance and interpretations. It also sets out there certain, like if you want to contact CRA and for any inquiries or anything. There's also they set out the phone numbers and how you can contact CRA for anything at that link. So that's just kind of a useful link for more information on all these things. And there's two returns, which is why I have a link to the electronic return. You can do the return electronically online, or you can do a paper form and submit it by mail to CRA. So who does this apply to? Now, the government has said a lot about marketing its policy here, how it's targeting foreign owners. The reality is, with any of these taxes, there's always a bit of a distinction between how these new laws and how these policies are marketed by the government and how they actually apply to you. And people may have found that out when dealing personally with things like the BC speculation tax and the empty homes tax. So people might think, oh, this is only a tax on underused houses, and just put aside the name of the legislation. The government's going to talk about how this only, most Canadians aren't affected and won't have to worry about it. I'm going to tell you right now that every Canadian should at least be putting their mind to it, because while they may not have to pay the tax, they may have an obligation to at least file a return, and they may be unaware of that. And that's where I think the government's marketing can be dangerous, because many Canadians will probably think, oh, my land here is owned through me and I'm Canadian, or it's a Canadian company or Canadian trust. I don't have to worry about it because I'm Canadian. And that's just not true, actually. So this tax applies to owners of residential property on December 31st of a calendar year. So you're looking at who is the owner on December 31st. If you're not the owner of a piece of residential property on December 31st, because say you sold the property on December 1st of a year, then you won't have to file a return. You also you won't have to pay or file a return if you're an excluded owner. So the definition of excluded owner, which I'll get into more fully, is very important. And it is the only category of people who really don't need to do anything under this legislation, but it is a very limited category. And then if you are subject to the tax because you are an owner and you're not an excluded owner and you have residential property, then there are a list of exemptions that are potentially applicable, which I'll get to. And if the tax is payable, it's 1% of the taxable value, which for BC purposes, we're normally going to look at the BC assessment value, though it could also be the latest sale price if that's greater than the latest BC assessment value. And there's also an ability to get a valuation done under prescribed rules and elect to use that fair market value if you prefer, but there are specific requirements in the legislation about what that valuation, how it can be done. All right, so owner, who's an owner? Now, I got the whole definitions out here. I'm not going to spend any time on it, but suffice to say that the owner, you're looking at the person that is the registered owner on title. So usually that's very easy to see. There's also some modifications there, like if you're a life leaseholder or things like that, or life tenant, that stuff's kind of not all that common anymore. So it's not something I would expect to see regularly, though in your industry that may be a different matter, but I don't believe so. Excluded owner. So again, these are the only people that really don't need to worry about this at all. The main one for most people that own their own home will be paragraph B. So if you're an individual who owns that land, but not as a trustee of a trust, and in that category, I would include a bare trust, which is very common, personal estate planning for people to transfer the beneficial ownership into their property and hold title as bare trustee for the benefit of another person, with the benefit that this avoids property transfer tax. So you really have to turn your mind to that and think, with this, I know this isn't really talking about your industry specifically, but, for your personal properties, I may be a Canadian citizen or a permanent resident of Canada for immigration purposes, but, do I hold that property in any sort of trust or partnership or anything like that? Paragraph C there is going to capture Canadian public companies, so not private companies. Also, certain public trusts like real estate investment trusts will be excluded under paragraph D. Paragraph E excludes registered charities. So obviously that is a charity that's registered with CRA and has a registered charitable number. So just a regular not-for-profit society that is not a registered charity, that does not capture you. And then certain other very limited, like Indigenous bodies, hospital authorities, but again, that's where the hospital authority is the owner, right? Which may not be all that common, but certainly very limited categories of excluded owners. And so that means anybody who's really a trust other than certain publicly traded investment trusts, that any owner that is a private company and any owner that is a partnership is likely going to have to at least file a return if you own residential property on December 31st. And so we had some examples here. This is one of the slides that Orla was going to go over, and I don't know. It seems that she still is not able to connect audio unless Orla can. No, I'm going to assume not. All right, so example, just some brief examples here. If you have ABC company, it's a registered beneficial owner of a property, so it's a private company, it's BC company, it is going to be an affected owner. It's going to have to at least file a return at a minimum. So the next one, Def Canada Corp Limited, probably not how I'm supposed to say that, but anyway, it's holding title as bare trustee for a public company. While a public company is an excluded owner, a private company holding title as bare trustee for a public company doesn't technically fall under that exclusion. So it won't be caught, and it will be an affected owner, have to file a return.
Hi, sorry to interrupt. Can you hear me now?
We can hear you now. Hi, Orla.
Hi, everyone. I'm sorry for the delay there. I had technical difficulties. My computer's not working properly. Okay, so yeah, my apologies. Would you like me to take over from the slide, Scott?
Absolutely. I was just going over the first two examples, so you could take it over at GP Limited.
Okay, so yeah, what we're doing here is running through the applicability of owner and excluded owner. So I think Scott just did ABC, so we'll go with DEF Canada Corp Limited. In that scenario, DEF Canada Corp is holding title as bear trustee for GHI Pubco Limited. DEF Canada Corp Limited is a private Canadian company, but GHI Pubco Limited is listed on the TSX. So in that scenario, we have a clear excluded owner because anything listed on the TSX is excluded.
Hold on, Orla. I went over that example and I came to the opposite conclusion because the company holding title is a private company, and so it's not excluded. And so this is good because this is the challenge that everybody needs to kind of go through, right? I mean, the beneficial owner here is a public company and an excluded owner, but the registered owner on title is not the public company. It is a private company, and it doesn't fall under that excluded owner definition.
Yeah, so I wondered if, I think this was something we talked about that was an issue with the legislation, that it doesn't necessarily address the bear trustee situation. So since the legal owner here is actually the private company, it could be the excluded owner. I don't know. You wouldn't use that as the exemption there for the excluded owner?
And so this is going to get to one of the points we're going to make at the end, is that if there's any doubt in this situation, the most cautious approach you can do, especially if you have an exemption available to you, is just file a return and claim an exemption out of an abundance of caution, because there are these types of, just gaps in the legislation, frankly, that shouldn't be there, that kind of don't deal well with this type of situation. But at the end of the day, the question is the owner a public company? And because with the definition of owner, you're looking at basically the owner that's registered on title. In this case, it's not it's rare for the public company to ever be registered on title, frankly, as far as I understand. It'll usually be some subsidiary company. And guess what? Subsidiary companies of a public company also don't fall under the definition of an excluded owner. So that's another gap there. And this is where I expect, I expect the government to come out with additional regulations that kind of address these situations as time goes on and they realize that these situations aren't adequately dealt with. But for the time being, I would say, out of an abundance of caution, I'm not going to say you're an excluded owner, and I'd be saying let's file a return here.
Okay.
It should be excluded. I'll say it should be excluded, but it's technically not.
And that makes sense. And the next example would be similar. So in this situation, we have GP Limited. I've used that abbreviation to say that it's a general partner company, but it's the registered owner, again, as trustee, but this time for a GPLP. The GPLP is a limited partnership. The GPLP is owned 100% by a Canadian REIT. So a Canadian REIT is an excluded owner, but this brings us back to the point that we just went over. Since the registered owner is a BC company, that's not a clear excluded owner. The true beneficial owner is an excluded owner, but again, this is a gap in the legislation. The next example is, I've just called it public long-term care home. So in this scenario, it's a registered and beneficial owner is Vancouver Coastal Health Authority. So that is a clear excluded owner. Then lastly, we have, I've just called it Care Provider Society. The Care Provider Society is the registered and beneficial owner. It's a BC not-for-profit society, but it's not a registered charity. So in this scenario, it's what we would call an affected owner rather than an excluded owner, because it's not going to fall into the excluded owner category for charities. You need to have a registered charity number.
Continuing on, so this is the definition of residential property, and you'll notice it doesn't look at, the BC assessment category. Like, it doesn't look at property that's assessed by BC assessment as residential. It doesn't look at how property is zoned. It would be logical to think these things are relevant to determining whether or not you do in fact have residential property, and it may be. But at the end of the day, the definition simply means this. It in the first paragraph A, just means a detached house or similar building containing not more than 3 dwelling units. So that's going to capture, your simple detached home, or maybe a home with a coach house attached to it or something like that. But if you're talking about, more apartment buildings, so say an apartment building with 4 or more like independent apartment units that aren't stratified, so you're talking about, one parcel of land, then that would fall outside the definition of residential property. But under paragraph B, you would get, semi-detached houses, row houses, so like townhouses, strata units, strata condos, and that type of thing. And then here, the definition of dwelling unit means, a residential unit containing private kitchen facilities, private bath, and a private living area, which got us into a debate last night between Orla and I about what is a private kitchen facility. Is any place you plug in a microwave or toaster oven a private kitchen facility? And we would say likely not. It probably is referring to, a full kitchen with an oven, stove type equipment, and as well as a fridge and sink. I would not think that anywhere you can plug, a simple small 120 volt appliance into for heating food, like a hot plate or a microwave, or would make anything to be a private kitchen facility.
Okay, so to drive that point home, we have the applicability of residential property to various examples here. So for example 1, picture a long-term care hospital in a 3-story building comprised of 50 private residence rooms with private bathrooms, but there's common living, kitchen, and dining areas, and it's 1 legal parcel. In this scenario, is that residential property or not? So you have to run through the facts on this one, and keeping in mind, we're not turning our mind at all to the owner, excluded owner. We're just looking at the residential property category here. So in this scenario, it's quite ambiguous. You're not hitting one of the clear categories. I would say that in this scenario, since it's just 1 legal parcel, when in doubt, just do a filing, because it's a simple enough filing anyways. For the next scenario, we have 4-story building comprised of 2 floors of long-term care and then 2 floors of assisted living. So the way that would look is there'd be a total of 16 assisted living units, each with their own sink, fridge, toaster oven, and private bathroom. It's all 1 legal parcel. Okay, so here we're trying to say, well, do we have different, it's all 1 legal parcel. And so what it's kind of could maybe fit into would be that apartment building style if there was more than 3 dwelling units. But in this scenario, there's probably not more than 3 dwelling units. So it's likely not residential. So they won't be required to do a filing. Wait a second, yeah. Third example, this would be assisted living in a house-like building with a common living, kitchen, and dining room, and each room has their own bathroom, 1 legal parcel. This is probably residential. Last example, a mixture of long-term care and assisted living in a 5-story building comprised of 100 strata units. The long-term care floor would all be 1 strata lot, but each of the assisted living units has its own strata and bathroom. So each strata unit is technically residential and will be required to do that filing.
Okay, so the next 3 definitions relate to specific Canadian entities that if you can fall under this definition, you have an easy out. So let's say you're an owner of residential property and you have to file a return because you're not an excluded owner. Maybe you're a private company. Well, the first question will be are you a specified Canadian corporation? And so here, there's different rules. Paragraph A deals with, companies with share capital, and paragraph B deals with companies like societies, that not-for-profits that do not have share capital. And for paragraph A, you're looking at basically who has 10% or more of the value in the equity of the company, directly or indirectly, or 10% or more of the voting rights. And if there's any individual that's not a Canadian citizen or permanent resident that exceeds those 10% thresholds, or any foreign company in the chain that exceeds those 10% thresholds, then you're not going to be a specified Canadian corporation. So hopefully you're dealing with situations where, you know, the whole company is ultimately owned all by Canadian entities and Canadian individuals, and you really won't have to put much thought into this. Especially with respect to the value thresholds, that can be difficult to determine because you might need to talk to evaluate or determine, well, if we have different share classes with different rights and restrictions, what are the value? And then paragraph B there, as I mentioned, for a not-for-profit, you're going to be looking at chairperson, presiding officer, and the directors. And hopefully, so you're going to want to make sure that the chairperson or other presiding officer is a Canadian citizen or permanent resident, and that at least 90% of the directors, maybe definitely make sure you always exceed that threshold at all times. But make sure all the directors are Canadian citizens or permanent residents. There's similar rules for partnerships and trusts. So in a partnership, you're looking at each partner of the partnership, and you're going to want to see, is every partner an excluded owner? So say a Canadian citizen individual or a specified Canadian corporation, referring back to that last definition. And with the trust, again, you're looking at all the beneficiaries having a beneficial interest in the trust, which might require a look at the trust indenture and figuring out, you know, who under this trust has a beneficial interest in the property, though I understand that in your industry, it is probably unlikely that you're going to have a trust as the owner, because this is looking, remember, at the owner. Who's the owner? So the structure might involve a trust up the chain, but if it's a private company that owns the land and it's the legal and beneficial owner, then you'd be filing a return as a corporation, not as a trust. But if for a trust, you're looking at potentially all the beneficiaries, including discretionary beneficiaries, where you have a discretionary trust, and you're going to want to make sure the beneficiaries are all Canadian individuals or Canadian companies that meet that specified Canadian corporation definition. And then these are the list of all the possible exemptions. And so the easiest one, if you can fall under it, will be one of those specified Canadian entity exemptions. So if you're confident that you're a specified Canadian corporation, unsure of how to file a return, just file a return and check that specified Canadian corporation box and be done with it, right? I mean, that will give you the certainty that you won't have any penalties for failing to file a return, which I'll get to in a moment. Same if you're a partnership. It's definitely the easiest out if you're confident you fall within those definitions. There are a number of other definitions, which I've just highlighted here briefly. You know, a lot of these won't be applicable to your industry in terms of care homes. Some of these will be limited to where the owner is an individual, especially, you know, the primary place of residence ones. It looks at the owner or the owner's spouse or child and things like that. But there is qualifying occupancy exemptions where you have long-term rental tenancy agreements, long-term being at least on a monthly basis. And if a property is tenant, you know, if you have a residential property like a condo unit that's tenanted out on a monthly basis for at least 6 months in the year, then you also have an exemption available for that purpose. I seriously doubt in the long-term care facility context you'd be dealing with seasonal vacation properties or anything like that. Oh, one more point. I'll just say, you know, all of these exemptions do have pretty specified conditions that you should review and make sure you meet. And, you know, that link I had at the beginning will link to government guidance and interpretations as to how they might apply that and examples, which might be helpful to you. And you're also going to want to make sure when you do claim an exemption that you maintain records that supports claiming that exemption. Because if you're audited, the government's going to want to see supporting documents to say, well, let's see the tenancy agreement, for example. So if that's the exemption you're claiming, you want to make sure you keep copies of all those records.
So to kind of put together everything that we've talked about so far, I've created a few examples here that we can go through, and you'll see that it can be quite fact specific on how you interpret this. So for this first example, care type, it'll be a long-term care home. Legal parcel is 1. It has 3 dwelling units. So to tell you a bit about that, it'll be a total of 50 rooms and 3 have kitchens and separate bathrooms. So technically there's 3 dwelling units plus 47 long-term care rooms. For the ownership structure, it would be a BC company as the registered owner, indirectly owned 20% by an individual who's neither a citizen nor permanent resident. So the first thing we want to look at is there a requirement to file? So then we have to do our analysis on whether it's residential property and whether it's an excluded owner. In this scenario, it's likely residential property because it's less than 3 units. So getting at that, it seems like when we get over the 3 dwelling units, the legislation is probably looking at something like an apartment building, which can be owned by one person, multiple dwelling units in it. But in this scenario, it's not getting caught by that, so it's likely residential property. Now, is it an excluded owner? No, it's not, because we have a BC company as the registered owner. So there's a requirement to file here. Then looking at the requirement to file, we want to see whether there's any kind of exemption available. In this scenario, it looks like they're not going to be able to use the Canadian or the specified Canadian corporation exemption, but they can likely use the occupancy exemption. So in that scenario, I'm sure that there's some kind of lease, well, they're not lease agreements, but agreements for occupancy by residents, which would be probably a combination of services as well as tenancy. So you'd want to file under that exemption and have those on hand. The other thing I would point out with this one, as we've said before, is it's a fairly simple filing because it's one legal parcel, so it's just one filing. So you might as well do it and err on that side. The next example is in an independent living. So in this scenario, let's say we have 20 legal parcels with 20 dwelling units. So the 20 dwelling units are because each of the units has its own kitchen, living area, and bathroom. Let's say there's a BC numbered company as the registered owner, and it's holding it as trustee for another BC company, which 5% of the voting shares are owned by neither a citizen or permanent resident. Okay, so is there a requirement to file here? Well, yeah, this is residential property. It's residential property because there's 20 different legal parcels. So it's getting caught in that almost condo style buildings. And now we have to say, okay, well, it's an excluded owner. Nope, not an excluded owner. So they're going to be required to do a filing for each of those legal units. Unfortunately, you can't do a filing where even though the ownership and the structure is the same for all of them, you put them all into one, you'd have to do a different filing for each one. Now you'd want to say, okay, well, what exemptions available here? In this one, specified Canadian corporate or specified Canadian corp, or would it be a trust? I guess this goes back to our analysis on whether you're filing as the registered owner or the beneficial owner. I think it's a trust. Scott, what would you say on that?
If it's holding titles bare trustee, I'd say you're looking at the trust rules.
Okay. Okay, so last example, it's an assisted living, one legal parcel. This scenario, it's a little difficult to determine how many dwelling units are here, and let me run through why. So in this scenario, we have 40 residents living in 7 house-like buildings, all on one legal parcel. Each building has a shared kitchen, living room, and dining area, but each of the residents within those buildings, so there's 40 of them, have a private room with a microwave, a fridge, and bathroom. The owner here is Care Company GP Limited, and it's the registered owner for the beneficial owner, which is GPLP, a limited partnership. Okay, so requirement to file. Well, is this residential property? This is where it gets a little bit tricky because we want to know what kitchen facilities actually means. And as Scott mentioned earlier, just on general analysis, we think that kitchen facilities implies that it needs to have an oven, a range, a stove, something like that. So simply having a microwave or a toaster oven, fridge, and sink would not qualify as a kitchen. So in this scenario, I don't think that we would call each of those dwelling units. So instead, in this scenario, it sounds like we maybe have, it's really hard to say because would you call each of those 7 houses a separate dwelling unit? I think you might. I think in this scenario, it'd be safe to just do the filing. Now you go, okay, well, am I an excluded owner or not? Excluded owner, no. Based on that structure, we have a GP holding title for a beneficial owner, not an excluded owner, likely required to file. Is there an exemption available for the taxes? So in this, yeah, it's a specified Canadian trust or partnership. I think it's a specified partnership, Canadian partnership.
Okay, so just some administration and enforcement notes. As I mentioned, there are penalties for failing to file. The penalties I've set out here are actually the minimum. It can also depend on the assessed value of the property as well, like a percentage of the assessed value. So for value properties, it could be greater. And the minimum is $5,000 if the owner is an individual and $10,000 if the owner is not an individual, say a corporation. There are additional penalties for failing to provide information as and when required or for making false statements. There's obviously, some anti-avoidance rules and auditing powers. If you're assessed the tax, there's an ability to object to assessments and ultimately to appeal to the Tax Court of Canada. As I mentioned before, there's a requirement to keep all records necessary to determine your obligations and liabilities under the Act. So, if you're claiming an exemption, you're going to make sure you keep the records that support claiming that exemption. Key takeaways here is that, while the government may market this as a tax on, foreign owners and making sure foreign owners of residential property in Canada pay their fair share, is what they love to say publicly, then it's actually much broader than that. And so everyone really should be turning their mind to this and thinking about it a little bit. A lot of the things here I've covered already. There's a lack of government notice being given to owners to file a return. When in doubt, file a return will be the go-to advice, I think, for a lot of people. A lot of advisors I know are saying that, just especially if you know you're a specified Canadian corporation, for example, but you're not sure if this really should be considered residential property or not. The government policies, the interpretations that I linked to at the beginning, does have some examples of properties that it would say is residential property and is not residential property. And it says, things that are not residential property include things like apartment buildings, but, there's nothing really there that is applicable directly that it would seem to these types of properties that you're using to provide care services. So for now, that may be updated and may end up including something that looks like the property that is relevant to your business, but or your not-for-profit society or whatnot. But in the meantime, when in doubt, probably just file a return. And there is an ability to request, make inquiries with CRA or to request rulings or interpretations. And again, information on how to do that can be found at that link at the beginning.
Yeah, so further key takeaways here for care industry or for care facility owners and operators in particular is, we don't think the intention of the legislation here was to capture long-term care, assisted or independent living. It wouldn't make sense given the stated intention because this isn't contributing to underused housing. It was likely just missed. However, the government hasn't released any kind of guidance to date on these type of facilities. As I'm sure Scott went over in the beginning, the filing deadline is April 30th, but now they've introduced this no penalty, no interest until November. So there is the opportunity to, contact the Ministry of Finance and get some kind of interpretation released on these, which is something that you might want to do. And then again, unfortunately, there's no blanket rule here. We can't just say, okay, well, it's the care home, it's assisted living, it's independent living. Each facility needs a fact analysis based on how it's actually held and what it looks like in that structure in terms of whether you have these separate rooms with kitchens. Yeah, so unfortunately, it's something you have to go off each one.
All right, and that's it. So now we can open it up to questions. I see there's a couple in the chat bubble there.
Hi, Scott. So I don't see any questions. A couple of people had to leave early, but just to remind everyone, the Q&A chat room is open and the chat is as well. So let's give people a couple of seconds here. Yeah, I'll let you know when a question pops up.
Sure.
Can you hear me, Scott?
I can.
One thing that one of our board members who we were talking to about this mentioned that when filing, you know, just to be on the safe side, there's no sort of checkbox to mark. So she created her own checkbox for long-term care or whatever facility it was. But that's the form itself seems to not lend itself to easy interpretation of what box you tick. Have you got any advice on that?
No, it certainly can be difficult, and I've had some clients send me copies of the returns that they completed themselves, and I had to provide a lot of comments. This is definitely something that I think you might want to be getting an accountant to assist with, because they'll be familiar with these types of CRA forms and submitting them and the procedures and everything, and they'll probably be in the best position to help you. So my recommendation would be to consult with your accountant. As for determining which box to tick, you really do have to do a close read of the form and just kind of follow the instructions, because it'll say tick this box or go here, or check this box or go here. Or you can, if you want to claim the specified Canadian corporation box when it comes to the exemptions, then you can just find that one and check it. I know I think it's box 620 or something. It's in the part 6 of the form. So you might just want to, skip all the stuff relating to principal residences and stuff like that, and move straight to that one and just check that box and be done with it. And then do the form, the form's like, I don't know, like total of 9 or 10 pages or something like that, right? And the first about half is, all these boxes, and the second half is where you're going to find defined terms. So, if you see something that's bolded in the form, my first suggestion would be to go to the back where you're going to, the back pages of that form, where there's going to be more instructions, and you might have some definitions of those terms set out for you. So that might be helpful as well.
Thank you, Scott. We have two similar questions, one a little bit broader than the other one. The first one says, does it make sense for the industry association to submit a ruling for the industry in general? And the second one is specific to LTC sites. And the question is, should we be writing a letter to the CRA to get LTC sites excluded?
Yeah, I mean, I certainly think you'd have, I don't think it's the government's intention to capture long-term care facilities, right? I mean, I certainly think it would look bad if this blew back when the government is saying, it's negatively affecting long-term care facilities. I don't think the government would like that publicity, right? So if you wrote a letter, or a ruling request or an interpretation, and I mean, you could kind of combine all those things into one letter, asking about what types of owners, the problem is with long-term care, I understand that there's various types of owners. Like some of you are going to be registered charities, some are going to be not-for-profit companies that are not registered charities, and some of you are private companies. And so it will vary how this applies to you, and whether it's residential property. But you certainly might want to ask, can you exclude from residential property like properties that are being used in the provision of long-term care in some way. And I think the government would certainly be sympathetic to that. I don't think it's the intention for this to catch long-term care facilities.
Well, we broached this subject with the Canadian Association of Long-Term Care, of which we're members, obviously, and their government relations company took a look at it. And as Scott indicated, the intent of the legislation is clearly not to capture this sector. And they thought the risk was very low. The problem is that even failing to file comes with such a high fine. So we'll continue to pursue through the Canadian Association of Long-Term Care some a request for clarity from the CRA on this. So they are aware of it, and we'll continue to pursue it.
I think ideally you would get something in writing, because the government is now releasing guidance and interpretations. And so ideally, at a minimum, you would want something in there saying, these types of long-term care facilities. But the problem is, what kind of facility you're talking about, right? Because some of these, they kind of look like a big dorm, right? I mean, you're talking like a big building with lots of individual units to sleep in with private, private bedrooms, basically, with their own bathrooms, but they don't have any kitchens. This does not look like it's the intent of this legislation to catch something like that. But if you were to simply buy a house, like just a regular old detached home, and use it to provide long-term care in some way, and you're not, a registered charity, then yeah, it looks like you've purchased residential property, and you're now owner of it, and so you should at least be filing a return, right? So it really just it depends. From what I gather of your industry, there's a wide variety of owner types and property types that you can have here, and so it makes it kind of hard to provide blanket advice.
And I think that's the key, is that every situation is a little bit different. There's not one size fits all. It really is good advice to get your own advice from your accountant and your lawyer, but we'll continue obviously to advocate for the industry as a whole.
Yeah, it might be simple enough for the industry. I mean, again, it will depend, but maybe if the industry could issue some kind of letter saying that if you're a licensed long-term care operator, and make it more about whether you have the licensing in place, and that could potentially cover a bunch of different ownership structures, and depending on if there's different legal parcels or not, but you actually have a licensing agreement. Okay, well, now you should be excluded.
Thank you. I think that answered the question. I have no more questions in our queue.
So I want to, on behalf of BC Care and Engage BC and all of our members, thank Scott and Orla for this very interesting presentation. It clearly is a policy that was, had a certain intention, and then the gap between policy and implementation. Sometimes in government is very small, sometimes very large. And here, I think it's very large, because it obviously was not thought out well ahead of time in terms of how they were going to roll this out and communicate it. So you've been very helpful for us today, and we really thank you for your time and appreciate all the work you put into this. I just wonder if the presentation would be available to our members.
Sure, we're happy to share that.
That'd be great, thanks. And so Andrea will send it. If you send Andrea a message, she'll get it out to you. And good luck with things. Don't get caught in the government trap. If in doubt, make a filing and claim an exemption, or at least get your marker in. Thanks, Scott and Orla, and thanks to all of our members and to Andrea for setting up this luncheon. Thank you.
Thank you.
Thank you.